Welcome back to the Deep Dive.
Glad to be diving in.
We're jumping straight into the Wall Street Journal Weekend Edition, the issue from July 1920, 2025.
Right.
And our goal today for you, our listener, is to quickly pull out the most crucial financial and business intelligence. No fluff.
Exactly. This edition is packed market data, economic forecasts, some major corporate plays, and those geopolitical factors impacting business.
So we'll distill it all, make it actionable.
That's the plan.
Okay, let's get started. We'll cover the economic pulse, then strategic corporate actions, and finally policy shifts.
The economic pulse and market dynamics.
All right, kicking off with the macro view. The latest WSJ Economist survey seems like there's been a real shift.
There has. What's striking isn't just, the lower chance of recession talked about now.
Uh-huh.
It's the GDP growth forecast for Q2. It's jumped significantly.
How much are we talking?
Projected at 2.2% now. Compare that to just 0.8% back in April.
Wow, that's quite a revision upwards.
It is, and it reflects some encouraging signs we've seen in jobs, unemployment figures, and inflation data softening a bit.
Okay, so the economic backdrop looks a bit brighter. How did the markets react this past week?
Well, we saw the S&P 500 and the Nasdaq push to new highs again.
Right.
The S&P was up 0.6%, Nasdaq up 1.5%. The Dow, though,
Lagged a bit.
edged slightly lower, down about 0.1%.
So connecting that market action to the bigger picture.
It really hammers home this ongoing theme, the sheer dominance of large cap tech.
You mean like NVIDIA?
Exactly. Think about this. NVIDIA, valued at $4.22 trillion. That single company is worth 65% more than all the stocks in the Russell 2000 combined.
65% more. That's staggering.
It is. And it underscores this trend we've seen for a decade now. Small stocks just significantly underperforming large ones.
What are the numbers on that long-term performance gap?
Over the last 10 years, small stocks returned about 6.6% annually. The S&P 500, 13.2%.
That's a huge difference. But historically, didn't small caps usually outperform? Why the flip?
That's the million-dollar question, isn't it? Historically, yes, going back to 1926, they did tend to outperform by about 2 percentage points a year.
So what changed?
A lot of it boils down to sector exposure, or rather underexposure.
To tech.
Precisely. Technology now makes up nearly 34% of the S&P 500's total value. Small cap indices just don't have that kind of weighting in the biggest growth driver of the past decade.
So that historical premium for small caps is just gone for now.
It seems swamped by the tech effect, yes. It would likely take a major shift, maybe broader economic growth lifting all sectors, for that old trend to reappear.
Okay, let's look at the consumer. American Express reported earnings.
Right, higher second quarter revenue, and a big part of that was a 20% jump in card fees.
People are still paying for perks then.
Seems so. Amex executives called consumer spending remarkably resilient. Customers are willing to pay more for those benefits, even if some are cutting back a bit on things like travel and entertainment.
Interesting resilience there.
It suggests a strong model, that loyalty factor.
And on a, well, maybe lighter note, McDonald's snack wraps.
Ah, yes. Back this month.
Apparently, they were such a hit they actually caused lettuce shortages.
That's what the Journal reported. The company said they were, quote, blown away by the response.
Even while their overall U.S. sales actually dropped recently.
That's the fascinating part. U.S. sales were down 3.6% last quarter. It's a real snapshot of consumer psychology, nostalgia maybe, a specific item driving huge buzz even if the broader picture is softer.
Shows the power of a comeback product, I guess, even disrupts the supply chain.
It certainly can.
Strategic corporate shifts and industry reconfigurations.
All right, moving on. This is where things get really interesting. Big corporate moves reshaping industries. First, a major energy deal finally cleared a hurdle.
Yes, the Chevron Hess deal, a $53 billion transaction.
Exxon was challenging it, right?
They were, claiming preferential rights related to a joint venture in Guyana, but an arbitration panel dismissed Exxon's claim.
So Chevron gets Hess.
Looks like it's clear now. This significantly boosts Chevron's upstream assets, bringing their total output close to 4 million barrels of oil equivalent per day.
A big consolidation play.
Definitely. Strengthening their core portfolio.
Okay, shifting to consumer goods. Reckitt Benckiser, they make Lysol, Dettol.
Correct. They're selling a majority stake in their home care business. It could be worth up to $4.8 billion.
Why the sale?
It lets them focus more sharply on those core health and hygiene brands like Lysol. We're seeing this across the sector, companies trimming their portfolios, getting leaner as consumers watch their spending. It's about prioritizing.
Makes sense. Now, tech. The fight for AI talent?
Yep.
It sounds like it's gone into overdrive.
Oh, absolutely. The journal calls Meta's efforts an astonishing recruiting blitz.
Big money involved.
Huge money, offers exceeding $300 million pay packages, and using exploding offers, basically take it or leave it very quickly.
Wow. And there was that failed OpenAI deal, too.
Right, OpenAI tried to buy a startup called Windsurf for $3 billion, but Microsoft, their main backer, objected.
So what happened to Windsurf?
Well, the CEO ended up going to Google instead. Google essentially bought the team in a $2.4 billion deal, what they call an acqui-hire.
So buying the talent, not necessarily the product.
Exactly. It highlights how intense this competition is, and it's also perhaps a way to navigate potential antitrust hurdles that a full acquisition might face.
Fascinating tactics. Now, how are traditional media giants coping with all these shifts? CBS made a big announcement about late night.
Yes, they're ending The Late Show with Stephen Colbert next May.
Why? It seemed like such a fixture.
The report cited $40 million in annual losses. It really underscores the immense pressure on traditional broadcast models.
Cord cutting, ad revenue decline.
Precisely. Especially as younger viewers migrate elsewhere.
And where are they migrating? YouTube seems to be a big winner here.
Absolutely. YouTube is now the most watched video provider on U.S. televisions. Over 1 billion hours viewed daily.
1 billion hours daily.
Yeah.
On TVs.
On TVs, yes. Through connected devices. And they're not just short clips anymore. They're pushing into longer content, higher quality stuff, even acquiring sports rights.
So directly competing with the networks now.
Directly. It's a massive shift in how content is consumed and where the advertising money is likely to follow. Less linear TV, more platform-based viewing.
Policy, regulation, and societal impact on markets.
Okay, let's pivot to policy and regulation. Often slower moving, but the impacts can be huge. The Affordable Care Act, marketplaces, for example. Sounds like premiums are set to jump.
Significantly. Insurers are requesting pretty hefty rate increases for 2026 plans.
How hefty?
The median requested hike is around 15%. That would be the steepest jump since 2018.
15% median. Are some states seeing even higher requests?
Oh, yes. In states like Illinois, Texas, Washington, Georgia, Rhode Island, the proposed increases are exceeding 20%. Some even closer to 27% or more.
What's driving such big increases?
It's a combination of factors. Rising underlying healthcare costs, certainly, but also changes in federal policy, especially around subsidies potentially being cut. This could hit the 24 million people enrolled pretty hard.
Yeah, that impacts household budgets directly. Okay, sticking with policy affecting households, the housing crisis, still a major issue, right? About 4 million homes short nationally.
That's the estimated shortfall, yes.
Oh, yeah.
And Congress is actually attempting something, a rare bipartisan effort.
On housing, what are they proposing?
It's a bill aimed at making it easier to finance accessory dwelling units, ADUs. You know, those smaller secondary units like backyard cottages or garage apartments.
Trying to boost housing supply that way?
That's the idea.
Yeah.
But what's also interesting here is the political overlay.
How so?
Well, the Journal notes that Bill Pulte, who heads the Federal Housing Finance Agency, FHFA, he's been echoing some of former President Trump's criticisms of Fed Chair Jerome Powell.
Really? About what?
Criticizing Powell over renovation costs at the Fed building, but also pushing for lower interest rates, framing it as a way to tackle housing costs.
So housing policy getting tangled up with Fed criticism and presidential politics.
It seems to be. It highlights how central housing affordability has become in the broader political debate.
Okay, one more significant policy piece, this one at the state level in Illinois. It sounds pretty concerning for their finances.
It does. There's a new bill heading to Governor Pritzker's desk concerning public pensions.
What would it do?
It would significantly sweeten pension benefits for what they call Tier 2 public safety workers, police, firefighters hired more recently under less generous terms.
And the financial impact.
It's estimated to add about $11 billion in new liabilities just for the city of Chicago.
Just Chicago?
Yes. And potentially over $100 billion statewide if other public sector unions manage to get similar deals.
That sounds unsustainable.
Some critics quoted in the Journal call it a complete denial of financial reality.
And Illinois already faces fiscal challenges, right? People leaving the state.
They do. The state has lost a net 1.6 million residents over time. And several major companies, Boeing, Caterpillar, Citadel, have moved their headquarters out. Adding potentially massive new pension burdens doesn't exactly help that situation.
No, it certainly wouldn't seem to. A tough fiscal picture there. Deep comments in Q&A. Okay, we've covered a lot of ground economic signals, major corporate shakeups, significant policy moves, all drawn from this weekend's Wall Street Journal.
Indeed. Now let's try to connect some of these threads and think about the deeper implications.
Exactly. This is where we offer some analysis for you, our listener, to consider for your own strategy.
Let's dive into those connections.
First question then. We talked about the struggles of traditional TV, like Colbert's show ending, versus the explosion of YouTube on actual TVs. What does this really mean for ad money and where investment in entertainment is heading?
It signals a fundamental, perhaps irreversible shift away from traditional broadcast ad models. The money follows the eyeballs, and the eyeballs are increasingly on integrated digital platforms like YouTube.
So capital flows towards creator content.
Yes, creator-driven content, longer-form videos on these platforms. They offer better ways to measure engagement, and things like mid-roll ads can be quite lucrative. Yeah. Expect more investment in platform-exclusive content, too.
Like sports rights.
Exactly. Live events, sports things that draw a committed audience. It makes pouring huge sums into traditional network shows with those high costs and dwindling linear viewers a much tougher sell for investors.
Got it. Okay, second question. Markets hitting highs driven by tech while small caps lag. Economists are, well, cautiously optimistic maybe. What signals should investors really focus on to get an edge in the next few quarters?
Given the current dynamic, you absolutely have to keep watching the drivers of large cap tech. AI spending is key there. Their performance is just so influential on the overall market right now.
And for small caps, any hope there?
For small caps, you'd need to see signs of a much broader economic recovery, one that lifts sectors beyond tech. Or perhaps a real shift in investor sentiment towards value, because small caps are historically cheap compared to large caps right now.
Policy matters here too, like tariffs.
Potentially, yes. You'd want to watch how things like proposed tariff policies might affect large multinationals versus smaller, more domestically focused companies. Small caps might be less exposed internationally.
So monitor tech, look for broader recovery signs for small caps, and keep an eye on policy impacts.
And remember, the GDP forecast's improving, yes, but expectations later in the year are still somewhat muted, suggesting continued selectivity is probably wise.
Okay, final question. We touched on several policy areas: ACA premiums, housing finance via ADUs, state pension crises like in Illinois, even shifts in green energy subsidies mentioned briefly. How should savvy investors think about integrating these maybe localized or sector-specific policy shifts into their broader strategy?
These policy shifts create very specific risks, but also targeted opportunities. You really need to do that granular analysis.
Can you give an example?
Sure. Rising ACA costs, for instance. That obviously pressures household budgets, which could impact consumer discretionary stocks. But it might also create opportunities for companies offering innovative, maybe lower-cost healthcare solutions or insurance models.
And the ADU bill.
If that passes, it could genuinely open up a new niche market for real estate development and financing, a specific growth area.
And the flip side, like Illinois.
Right. State fiscal crises like the pension situation in Illinois act as a deterrent. They can accelerate companies leaving, damage the state's creditworthiness, and signal broader regional economic risk. It's a clear negative signal for investment in that specific geography.
So it's not just about federal policy.
Absolutely not. State and local policies, sector-specific regulations, these all need to be part of the mosaic for investors allocating capital effectively. Policy analysis has to be a core input. Outro.
Well, that brings us to the end of this deep dive. We've distilled some key narratives from the Wall Street Journal's weekend edition.
Hopefully providing you with a concise, high-value briefing.
Our aim was clarity, impact, and connecting those dots for you.
We hope it gives you some fresh perspectives on how these different market forces interact.
Before we sign off, here's a final thought for you to consider. As we see this relentless pace of tech adoption alongside rising geopolitical tensions, documented so well by the Journal, where is the next major market disruption likely to come from? Is it a legacy company in a traditional sector being forced to radically adapt? Or is it the private capital currently pouring into areas like defense innovation, maybe operating more under the radar?
An interesting question to ponder. Adaptation versus new creation.
Something to keep in mind as you navigate the markets this week. Thanks for joining us on the Deep Dive.